All right, everybody, I'm Logan Alec. I'm a CPA. Happy Friday. Today, I'm going over a report that the Department of the Treasury issued just yesterday. It's called the American Families Plan Tax Compliance Agenda. American Families Plan, what is that? If you've been following the channel, you know this is part of Biden's big infrastructure push. This is the social infrastructure piece. This is the extension of the expanded child tax credit into 2025, right? This is money for the daycare, for the childcare, all these social infrastructure pieces that's on the Biden administration's agenda. That's what the American Families Plan is. I went over the White House fact sheet on the American Families Plan in detail. I think that was last month or maybe earlier this month. I did that. Link at the top of the screen and in the description below if you want to check that out. And it's a part of the American Families Plan, as I went over in that video and in a separate video. The Biden administration wants to infuse the IRS with $80 billion to increase compliance activity, audit activity, collections activity. This report basically details that plan. I've gone through it. I've made some highlights and some notes that I want to go over with you. Part of this is giving the IRS more insight into your bank account activity. It's a little concerning. Is it a first step, a preliminary step of things to come? I don't know. I sure hope not. I'm going to get into it. Before we get into that, though, I want to mention, did you guys see the crypto market today? Look at this. This is the Bitcoin chart. We're on 7:30 this morning. Look at that. Look at that red. Which one of you whales in my audience dumped, huh? Who's to blame for this? So crypto's tanking. And some of you have asked me, Logan, are you buying crypto on this dip? And my answer is, look, I'm always putting a little bit of money into stocks and a little bit of money into crypto just continually, right? I dollar cost average. That's my strategy. As I said in my crypto video the other day, at any given time, no more than 5 to 10% of my portfolio is invested in combined individual stocks and cryptocurrencies. I'm big on index funds. If you watch the channel, you know that. One platform that I have been buying a little bit more cryptocurrency in is called BlockFi. I've kind of been exploring it. I got about half a Bitcoin in there and almost 4 Ethereum in there. This platform basically pays you interest on your cryptocurrency in cryptocurrency. So, for example, on Ethereum, the rate is 4.5%. On Bitcoin, it's 5%. I'm just exploring this. There is risk here. This is not a bank. This is not FDIC insured. BlockFi could get hacked, right? That's a possibility. You could lose all your coins. What happens if BlockFi goes bankrupt? They say that users' assets are kind of separate from that, but I don't know. There's risk here. Okay, I wouldn't recommend having all of your coins in any one place. This is one place that I have accumulated a little bit more Bitcoin and Ethereum recently. Right now, BlockFi is having a bonus where if you deposit 100 more in crypto, you do get like a bonus here. Here's a chart here. You deposit $100 to $249, you get $15 worth of Bitcoin. If you have more than that, you get $250 worth of Bitcoin. So I have a link to BlockFi in the description below if you want to check it out. Again, this is just like with all things cryptocurrency. This is a risk. Okay, do not view this as safe. Just because it pays interest does not mean this is as safe as money in the bank, okay? This is for people who understand the risks of cryptocurrency and the risks of these platforms that lend, right, like BlockFi, and who understand the risks there, okay? But let's get into this Treasury report here, the American Families Plan Tax Compliance Agenda. Okay, so basically what is this? So at the beginning it talks about Biden's, he wants to close the tax gap, right? Which is the difference between taxes owed and the amount that's actually paid, right? So according to the Treasury, this tax gap is $600 billion in 2019 and will rise to about $7 trillion over the course of the next decade if left unaddressed. That is massive, folks. That's over 10x, right? So they're saying the tax gap, and I think this is the cumulative tax gap they're talking about, up until 2019 is $600 billion, but they're saying it's going to 10x over the next 10 years. I don't think this is just $600 billion for 2019. I think this is the cumulative tax gap for all tax years, right? They're saying it's going to 10x over the next 10 years, roughly equal to 15% of taxes owed. Now, so a big part of this initiative is more information reporting to the IRS. Okay, because one thing that comes in that you'll see throughout this report is the Treasury Department saying that, for wages, right, where people get a W-2 for it, and the IRS gets that same W-2, and the IRS knows exactly how much you were paid in wages. Compliance in terms of payments is 99%. 99% of taxes due on wages are paid to the IRS, right? The IRS knows how much you made. In fact, your employer withholds some taxes out of your paycheck, every time you get paid. Right, so compliance on wages, right, where there's a lot of reporting and kind of built-in compliance is 99%. But they're saying compliance on less visible sources of income, such as, say, business income, rental real estate income, sources of income where, you might get some 1099s that show you the top line, but the deductions you self-report, right? Those of you with a small business know this, or a large business, or rental real estate. On your tax return, you say the amount of rents you collected. And if you have a property management company, they might give you a 1099 miscellaneous for that with, I think it's box 1 rents, right? So the IRS knows the rents you collected. But all the expenses, you come up with those yourself. You self-report those, right? Other than mortgage interest, right, where the government does get a 1098, but other things, the utilities you paid, the repairs you made, right? Even the property manager's expense, things like that, you self-report those. Okay, so the IRS is saying that, there's room there for people to kind of cook the books a bit and report more expenses than they should. And what they're pushing for here, what Treasury's pushing for here, is more visibility, okay, for the IRS into your bank accounts. Okay, I'm going to get into that in a bit. So they're saying the compliance proposals in the American Families Plan provide the IRS with the resources and information it needs to overhaul and enhance tax administration, evasion. They say that taxpayer service is going to be improved. They talk about later in this report about how crappy of a job the IRS does at picking up the phone, right? And they're going to try to improve that. So right here they're saying this is the $80 billion cash infusion, right, that we've talked about before on the channel. So they're saying the IRS will grow manageably, no more than around 10% annually. That's actually pretty big. Right, growing 10% annually, you will double your size in less than a decade, right? So this is pointing out that over the last decade, the IRS budget fell by about 20%, and they've lost specialized auditors as a result, right? Who conduct examinations of kind of high-end tax evaders. So the IRS is definitely looking to hire at those higher level positions. Now here we talk more about the compliance, right? They're talking about how W-2 forms, right? You get great compliance with W-2 because, the government knows about the wages and they know exactly how much you made. You can't really escape. But they say without third-party reporting, compliance rates fall below 50%. So they want to strengthen third-party reporting, right? Just like right now, you get a W-2 for your wages. Government gets a W-2. You get a 1099, right? For other forms of income, government gets a 1099. Well, this is saying the president's proposal leverages the information that financial institutions already know about the accounts that they house. Financial institution would add information about total account outflows and inflows to existing reporting on bank accounts. What is this saying? It's going to talk more about this later, but this is basically saying the president, the Biden administration, is pushing for the IRS to know on an aggregate basis how much total money went into your bank account for the year and how much total money went out of your bank account for the year. Is this a precursor to even more details, perhaps later down the line in a few years or maybe a decade or two? We'll see. Let's move along here. So they're saying that, okay, well, if people know that now the IRS knows exactly how much cash went into a bank account during the year and exactly how much cash went out of a bank account during the year or withdrawals, then maybe voluntary compliance will rise because would-be tax evaders now know, right, that the IRS has a lens, they're saying, into this perhaps previously unreported income or over-reported expenses, right? This is a little scary to me. I don't know how much I want the IRS to know about my banking activity, right? We know that right now there is that $10,000 reporting threshold, and that reporting threshold is not just for banks, right? If you own a jewelry store and somebody buys a piece of jewelry for $15,000 cash, you have to file that Form A300, right, and report it to the IRS, right? Banks too, they have to do the currency, what is the currency reporting? I forget what exactly it's called, but they do have to report, cash amounts that exceed that $10,000 threshold, right? Well, Biden administration is pushing for even more insights into bank accounts given to the IRS. They talk about kind of updating the programming language in IT here. Here's another interesting part here. They want more regulation of tax preparers. So I actually didn't know this. So unregulated tax preparer, what's that? Unregulated tax preparers are tax preparers who are not CPAs like myself. They're not IRS enrolled agents. They're not attorneys. They're kind of just off the grid, right? In terms of, being actually regulated by some governing body, right? Whether it's the Bar Association for attorneys, whether it's the State Board of Accountancy for CPAs, whether it's the IRS itself for EAs, right? They're kind of off the radar. They're not regulated. So this Treasury report says that unregulated preparers actually submit more returns than all other preparers combined. That's fascinating to me. So if you take all the returns filed by CPAs, EAs, attorneys, other forms of regulated preparers combined, right, the number of returns submitted by unregulated preparers exceeds those submitted by regulated preparers. So the Biden administration wants to basically make more regulation for tax preparers, right? So that more and they talk later in this report about how unregulated tax preparers often get the taxes wrong, or they actually do shady stuff. I'll get into that later. Okay, so overall, Treasury expects that all the stuff they're pushing for will raise $700 billion in additional tax revenue over the next decade. Here's kind of a chart here. All right, so now they're talking about the tax gap. This is their tax gap chart here. I'm not going to go through this chart because I kind of want to move this along here. Okay, so this is talking about how people who underreport their income, the underreporting of income tends to rise as taxpayers' income rises, right? And that's for a few reasons. One reason is that higher income taxpayers tend to have businesses, own real estate, right? Things like that, where there's voluntary information supplied to the IRS. There are deductions, right? So there's more room there, to underreport the true amount of tax liability, as opposed to lower income folks. Oftentimes, their only source of income is the W-2 job, right, which the IRS knows all about. There's no room to underreport anything there because all the money they made is already reported directly to the IRS through the W-2, right? And they talk about this again, right? For ordinary wage and salary income where employers share a Form W-2 with both employees and the IRS, as well as automatically withhold taxes, compliance is very high with only an estimated 1% misreporting rate, okay? And for opaque sources of income that accrue disproportionately to higher earners, like business income, proprietorship income, and rental income, misreporting is estimated to be 55%. They're saying the majority of business income and rental income is misreported. Is that true? I mean, how would they know if it's not being reported? I guess maybe they, based on audits and stuff and proportions. But this is a pretty bold statement. It's basically saying, hey, you business owners out there, you rental property owners out there, it's more likely than not that you're misreporting your income. And guess what? Over the next 10 years, we want to make sure you don't. That 55% figure there, that's pretty shocking that that's what their estimate is. This is talking about e-filing, right? How technology and e-filing has helped to stifle tax evasion. Now this is talking about the IRS's tax processing system, how they process tax returns. Why does it take so long? Why does it take so long to get my refund? Why does it take so long for the IRS to process a tax return? Well, the COVID thing was one thing, right? A lot of the doors at the IRS were shut for a lot of last year, right? And they're still catching up on so many returns that they haven't picked up. But also beyond that, this Treasury report says that the IRS's core tax processing system for individual tax returns is called the Individual Master File System, and it's written in programming language that dates back to 1962, making it one of the oldest IT systems in the federal government. They say elsewhere in this report, I don't think I highlighted it, but they don't even teach a lot of this language anymore, right? So, they want to beef up and improve the IT and technology systems as well. There's more stuff about the IT system here. I'm not going to really get into that. Okay, here's where they talk about the phone calls. They said that the IRS had the resources to answer only 29% of the 100 million telephone calls received in fiscal year 2019. That means if you call the IRS, there's a greater. So if you call the IRS, there's a less than 1/3 chance then that they're actually going to pick up the phone, right? Less than 3 out of 10 calls are answered by the IRS. And that was in fiscal year 2019. And they say during many months of the COVID-19 pandemic, the combination of resource constraints and a shift to remote operations further complicated service efforts and reduced service levels. Yeah, and I know that many of you tried to call the IRS last year either about your refund or some other matter, and you couldn't get through. This is talking about the budget shortfalls of the IRS since the early 2000s. The IRS budget as a share of GDP has been trending downwards. Now, this was really interesting to me. So in 2000, if you take our total gross domestic product, right, the value of all goods and services produced in the United States, the IRS budget was 0.08% of that. But look at this downward trend. Looks like Bitcoin the past few months. 2020, 0.05%. I mean, it's only if without the Biden administration stepping in here, they're saying that, well, this would probably cut in half, right, if we don't do something. So they really see a lot of push or a need to push for more money for the IRS. Now, this was really interesting to me. This is about auditing now. So as many of you know, when it comes to tax returns, you have your individual tax return, 1040. Also, various business structures have their own tax returns. For example, I run my business as an S corporation, so my business files a Form 1120-S. And then that 1120-S has a K1 to me, Logan Alec, and I take that K1 and report the information from that K1 on my 1040, right? Another form of tax return is the 1065. That's the partnership tax return, right? If you, let's say you set up an LLC to invest in rental real estate, you have some partners, you all put money in, you invest in this piece of rental real estate, maybe one guy's the sweat equity partner and he gets some kind of a fee. You have some arrangement, right? Well, that's a partnership, right? Whether you form an LLC or not, it's a partnership. And you would have to file a partnership return, Form 1065, right? And each one of those partners likewise gets a K1 that shows them their share of the partnership's income and loss credits and deductions that the partners report on their individual tax returns. So, and this is fascinating here. More than 4.2 million partnership returns were filed in calendar year 2018, but the IRS only audited 140 of those returns. That's crazy. Out of 4.2 million partnership returns, only 140 were audited. And the figure for S Corps is down here. Only 397 out of the 4.8 million S Corp returns were audited. That's abysmally low. For the partnerships, that's an audit rate of, get this, 0.00004%. So what's the IRS saying here? They're saying, hey, or what's the Biden administration saying here? They're saying, hey, IRS needs to audit more of these types of returns, right? Because think about it. Partnerships. What's held in a lot of partnerships? Real estate, right? Where people can drum up a lot of deductions, right? There are deductions for rental real estate, depreciation, and obviously the cash expenses you have, but some unscrupulous folks might over-report those deductions, and the IRS has no, apart from an audit, no way of really knowing whether those deductions were overstated. Right? Same thing with S Corps. All S Corps are small businesses. Same thing. Business owner self-reports his or her income and deductions on the return. IRS doesn't know how much they paid for advertising or, whatever. I mean, they know the salaries and wages, right? Because the S Corp owner files a payroll tax return and a W-2, obviously. But apart from that, other expenses can be the Wild West. So that's their point here. This is also interesting. The share of audited returns has declined by nearly 45% between 2010 and 2018. So in 2018, the share of audited returns declined by nearly 45% since 2010. That's crazy. Here's a little chart here showing the audit rates. So all filers, and I think this includes individual and business, risk of being audited in 2010, 0.93%, 2018, 0.51%. For individuals, almost cut in half, 1.11%, 0.59%. Earned income tax credit, we know it's a little higher for you. Obviously, the higher your income goes, the more of a chance you have of being audited. But look at it, the corporate. So look at this though, earned income tax credit. So they say that the IRS's compliant efforts is to go against, go for the rich, right? And the wealthy and the high income. And that's true. We see this borne out here on the chart. Look at the percentage of being audited if your income is over 10 million, right? 2018 6.66%. But then look at the corporations though. Audit risk of a corporation 0.88%. That's just a little more than half of the risk for an earned income tax credit recipient who was probably on the low income, right? If you qualify for the earned income tax credit, which is based on your income and family size. So something's a little amiss there, right? Does the earned income tax credit get abused? Sure, of course, right? But the fact that corporations are audited at 0.88% and partnerships at a rate of 0.00004%, something's a little wonky there with the narrative. This is all just about, targeting the high income folks, right? they're going to get this level back up to this at least, right? At least. So it's politically correct to say that, this is only about going after the rich folks, but they're going to go after everybody more. They're talking about the complexity of auditing partnership returns. And so here's another thing here that's an interesting point. So they say, the vast majority of taxpayers are in compliance with the IRS. They file their tax returns on time and they pay the taxes due. Okay. However, if compliant taxpayers start to think that, there's really no risk, kind of overstaying those deductions a bit because the IRS is never going to find out. The IRS is saying there's going to be attrition here, and that the Treasury is saying there's going to be attrition here, and that more and more otherwise compliant taxpayers will go out of compliance, and they're gonna maybe cook their books a bit more if there's no perceived risk. If they think the IRS has no teeth, they're not going to get in trouble, so why not, right? So they say visible enforcement efforts can keep taxpayers compliant. Here's a section here on the relationship between the tax code and racial inequality. You can read that if you like. Also income inequality. They're saying audit rates will not rise. Does it say period? For those with less than $400,000 actual income? No. They say audit rates will not rise relative to recent years for those with less than $400,000 in actual income. Okay. So we go back up to this chart here. This tells me that if you're an earned income tax credit, now they're probably looking at this figure, right? They're saying, okay, if you make less than 400 grand, we're not going to go higher than what it was in 2010. Oh, but they're still going to do a heck of a lot more audits, right? Because right now, if you're an earned income tax credit recipient, your audit risk is 1.41%. They're at least probably going to want to bump it back up to 2.39. Well, 1.41% to 2.39%, that's like a 70% increase, right? So see how they kind of get around it, right? They're saying, we don't want to touch you if you're below 400,000, but they do. All right. Fairness and efficiency. Okay, so they're saying the tax code will be fair when it no longer benefits opaque sources of income relative to wage labor, right? So they're saying that, look, if you're a W-2 wage earner, basically IRS knows everything, how much you owe, and you're gonna be compliant, right? Because IRS knows how much you owe. Well, but if you're a business owner, or you own rental real estate, that's a more opaque source of income, right? So they're saying, well, if we enhance compliance on business owners and those rental real estate, then the tax code will be fair, right? Because they won't have the same amount of opportunities to kind of cheat on their taxes that are unavailable to wage earners. So we're talking about rebuilding the IRS, $80 billion in IRS priorities, right, to pay for the newly expanded tax credits. Here's a year-by-year estimate of additional resources to the IRS from 2022 to 2031. You can check out this chart if you like. Okay, so here's the hiring. They want to hire and retain at least 5,000 new enforcement personnel at the IRS. $6 billion to IT modernization. Okay, now this is a really interesting part. Increased information reporting. So they're saying that financial institutions, such as banks, house a lot of valuable information and indeed already provide third-party reports to the IRS. For example, that $10,000 cash transaction report. But see, look at this. The President's proposal requires information reporting on financial accounts to increase the visibility of gross receipts and expenses to the IRS. Current reporting of gross receipts exists for only certain types of revenue, and there is no information reporting on deductible expenses, right? So what is this? The reporting of gross receipts exists for certain types of revenue, right? That's 1099s. No information reporting on deductible expenses. This is why the tax gap for partnership, S corp, and proprietorship income is estimated around $200 billion annually, with the net misreporting percentage of certain income categories exceeding 50%. They're saying third-party information, we already collected on so many types of tax things like wage, pension, and unemployment income. So why don't we make this more equitable by getting more tax reporting for other things like business expenses? So this is saying this new reporting regime would build from the framework of the 1099 interest reports that taxpayers already receive from banks when they earn more than $10 in interest from a bank, brokerage, or other financial institution. Financial institutions would simply report additional data on the financial accounts of these existing information returns. Specifically, the annual return would report gross inflows and outflows on all business and personal accounts from financial institutions, including bank, loan, and investment accounts, but carve out exceptions for accounts below a low de minimis gross flow threshold. Wow. So they're saying that maybe on the bottom of the 1099 interest you get from your bank, they want banks to report the gross inflows and outflows on all your business and personal accounts. They have a de minimis here. That means that, if it's under a certain amount, they're not going to report it. I don't think they don't really say what that de minimis would be. But let's camp out here for a second. This is kind of scary. So not only will the IRS know about the $10,000 transaction thing, they'll also know the total gross amount of inflows into your bank account during the year and the total outflows out of your bank account during the year. Privacy concerns. And this might not be the first step. What if this kind of gets passed or it goes through, kind of under our noses? But then maybe in 5 or 10 years, they're like, well, you know what? I mean, we've increased compliance so much, just having the gross inflows and outflows from bank accounts. Think of technology in 10 years, how quickly data will be able to be transmitted. To increase compliance even more, to pay for even more of these social programs, I think, the president or whoever's president then could say, hey, I think that the IRS should get all banking information from all bank accounts, business and personal. Oh, it's to increase compliance. Look at all these taxes that we, the revenue we increased from taxes over the past 10 years, because now finally we have to get a report of these business owners and, rental property owners' outflows out of their bank accounts, so we can see that, if they're over-reporting their expenses. So why not just get all the bank account information from all the bank accounts to really make sure people are in compliance tax-wise? That's frightening. That's a huge invasion of privacy. And maybe this is where it starts, right? Just a report of all gross inflows and outflows in all business and personal accounts. Something to think about. I'm not saying it'll go that far, but this seems like the first step in something that could go that far. I don't know. Now they talk a little bit about crypto here, kind of relevant to the beginning of this video. So they're saying the reporting regime would also cover foreign financial institutions and crypto asset exchanges and custodians. Okay. So they're saying virtual currencies have grown to $2 trillion in market cap. I think it's lower now, right? After kind of this recent crash, I think like 1.7 trillion or something like that. I think I want to do a video on crypto taxes eventually, maybe later this year. So they say cryptocurrency already poses a significant detection problem by facilitating illegal activity broadly, including tax evasion. I love this. Whenever you hear about crypto, right, from the government or something, that's, it's connected to illegal activity and, it's so illegal. It's like, guys, a lot of us, we're just trying to make a buck, right, on our little Shiba coins. Anyway, so they're saying the president's proposal includes additional resources for the IRS to address the growth of crypto assets. Despite constituting a relatively small portion of business income today, cryptocurrency transactions are likely to rise in importance in the next decade. So they're saying that, as with cash transactions, they want businesses that receive crypto assets with a fair market value more than $10,000 to be reported on. So it looks like they're pushing for more compliance, more information reporting with respect to cryptocurrency assets. Now, I know a large part of the cryptocurrency community is not really going to like this, right? Because, they're all about decentralization and, kind of anonymity and things like that. So there might be a pushback. Well, there will be a pushback here, right? And again, okay, $10,000. A lot of you might not be transacting in $10,000 worth of crypto. But what if this is just the first step, right? And that's always what you got to have in the back of your mind. Okay, we're starting here, but what's kind of the next step in this progression? If people are okay with this, are they going to be okay with this? And if the government can do this, then maybe the government can get away with that, right? Okay, so other compliance proposals. This is talking about the tax preparers. This is interesting. It says, during undercover visits to 19 randomly selected unregulated preparers, only 2 calculated taxpayers' refunds accurately. So this is saying the government sent undercover people to 19 randomly selected unregulated tax preparers. And out of those 19, only 2 of them calculated the taxpayers' refunds accurately. That's like just a little over 10%. Right? I don't want to extrapolate that to all unregulated tax preparers because this is a sample size of 19. But still, that's saying something, right? That these undercover or these unregulated tax preparers might be doing taxpayers a disservice by preparing an inaccurate return. But they say the issues of unregulated tax preparers go beyond the quality of services provided. Some unregulated preparers enrich themselves by ascribing to themselves a portion of taxpayers' refunds, or they commit fraud while failing to sign returns, so-called ghost preparers. At the bottom of your tax return, there's a place for you to sign, and there's a place for your paid preparer to sign. And if you paid somebody to prepare your return, and they don't sign down there, that's fraud, okay? What's the consequence to you? If you're audited, and you're saying, well, the preparer told me to do this, or blah, 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 you don't have that recourse if the preparer don't sign their name down there, right? So it says, leaving the taxpayers who are audited without the ability to prove that fraudulent returns are the fault of unscrupulous preparers. So they want to increase these additional penalties for ghost preparers. Well, okay, and here's the conclusion. So that's about it, folks. So what do I think of this? Well, the IRS has been understaffed for a while, and this goes both ways, right? No one wants to be audited. I don't want my clients to be audited, right? So it's kind of a bummer that probably audit activity is going to increase. But on the other hand, there are IRS professionals in appeals, right? I've worked with some appeals officers at the IRS who have just been so helpful and so understanding of my clients' situations. Brighter, right, than your everyday kind of other employees at the IRS. So this can kind of go both ways. I think some of this is going to obviously increase, obviously audit risk, but also perhaps help taxpayers in some ways, whether it's through appeals or just enhancing the IRS's, maybe their ability to get payments to people, right? If there's more payments going out, like, this child tax credit thing, right? If this becomes something that goes into 2025 or even permanent, like some mainstream funds are pushing for, it'd be nice if that's more streamlined. So pros and cons, of course, pros and cons. The big concern to me is that increased reporting from banks to the IRS. That seems a bit invasive to me, right? For the IRS to know all the inflows and outflows, well, at the aggregate level, combined level, on an annual basis that comes out of my bank account. Maybe that's not terribly concerning just as is, but like I said, is this just the first step to having kind of universal transaction by transaction, perhaps even real time someday, reporting of bank account information to the IRS? That I would not, in the name of compliance, right? That I'm not a fan of. So let me know, what do you think about this? Are you comfortable with that? Are you comfortable with the IRS knowing this, additional bit more of information? Just to clarify, okay, just so it's not clear. Right now, all the president is pushing for is for the IRS to know that the total gross amount of income that went into your bank account during the year. Okay, let's say $100,000. So there'd just be a line that said $100,000 on maybe the 1099 interest, and the total number of gross outflows out of the bank account during the year, right? So maybe $80,000 or something, right? That's it right now. Just two numbers, right? Total gross annual inflows for the year, total gross annual outflows for the year. Okay, that's it. Not detailed, but I'm just wondering if this will eventually become something a bit more invasive. Let me know what you think about all this, about the president's plan here to beef up tax compliance And be sure not to miss this video right here, in which I talk about offers and compromise. If you owe the IRS, be sure to check out this video right down here, in which I share more information about how the IRS is going to get a whole lot meaner. Bye-bye.